Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Adam Coons is with us. He is the co-chief investment officer at Winthrop Capital Management, and he joins us from Indianapolis. Adam, thanks for joining us Sunday night, your time. I'm curious as to what you were hearing last week from clients with all the volatility we saw in markets, particularly heavy selling in the Monday session last week.
Well, when we have heightened volatility and kind of a more chaotic market, investors start to kind of wonder how much worse can this get, and that's always the first question that we receive is this just is this a buying opportunity? Is this just a short-term blip, or is there more to this? And so I think when we're looking at it, it's kind of too early to tell. But one of the things that we were really focused on was volatility. Obviously, we saw the VIX spike to 60, which is an incredible move. And then if you're a bond trader, you're looking at the MOVE index, very similar. That also had quite a spike. So we're seeing volatility pick up. It did come down considerably by the end of the week, but that shows us that investors in general are going to be quick to try to sell any kind of bad news at this point. So we've kind of gone in a different direction where there was a time period where bad news was good news because it meant that the Fed might cut. Now it feels like we're entering that regime where bad news actually could be bad news for markets.
So what has that thinking done to your investment strategy? Were you moving things around in the equity trade last week?
We were. So we were kind of doing a couple of things. One is we did see it as a general buying opportunity for some of the higher quality tech names. It was kind of one of those baby with the bathwater type mentality where everything in tech seemed to be selling off quite hard. Some names, they should have been, like an Intel, down 25%. I think that was probably a move that needed to happen because the business model there is deteriorating. But then there were other names like Alphabet and Microsoft that we felt like, if things do start to roll over, those are still names that we want to be in because they are higher quality. They're low debt, they're low leveraged, and they have high cash flow, so they can sustain through maybe an economic downturn. And we don't think, even if we do see some sort of recession or downturn, we don't think it's going to be that harsh. So those are the type of names that we were buying during that sell-off. And so that kind of just goes right into our overall strategy of kind of moving more defensively. So we, like I said, I did the quality factor that I pointed out just a minute ago. So lower beta, higher quality names is where we're shifting to on the equity side. And then on the fixed income side, we do still like the long duration fixed income trade where you're buying long treasuries or high quality corporate bonds, so that because we do think that interest rates are going to come down, and they're probably going to come down quite quickly on the long end.
So you mentioned Alphabet and Microsoft, and I'm wondering, because we'll have the earnings from NVIDIA at the end of the month, I think on the 28th. Have you heard anything about the AI trade that's giving you cause for concern?
We have. So, and you kind of heard it in some of the earnings calls with big tech like Alphabet, where they are starting to cut back on their spending. They're obviously still there's still growth in spending, but the acceleration of that has started to come down. And so when you've got a stock like NVIDIA that's really priced to perfection, where they need substantial growth, really right now you're looking at 50% growth rate over the next 5 years in order to just justify the price of it right now. So I think if you started to see any pullback in spending on chipsets, it could be quite harsh for a name like NVIDIA, kind of, at the tail end of the earnings season here.
So we have the CPI data midweek. Before then, PPI, retail sales. So a lot to kind of consider when you're looking at the American economy. How do you feel about U.S. inflation right now? Are you confident that it's easing to the extent that the Fed will have room maybe in September to cut at least by 25 basis points?
I actually don't. I think getting to that 2% is going to be difficult and it's going to be slow. And so I think that we're running the chance that because inflation might surprise to the upside as we kind of head into year end and this print we have coming up this week, I think we're going to get a lot of mixed data over the next several months, and it's going to make it difficult for the Fed. It's going to make it difficult for investors to try to, project what's going to happen. And so I still stand by. I think the Fed is going to be slower to act than what markets are predicting right now. If you look at the front end of the cycle, they were slow to increase interest rates. I think they're going to be slow to decrease interest rates, especially if we get any data points that show that we're still not there. And so I think, hitting that 2% target is going to be difficult from where we're at right now.
You mentioned the bond market a moment ago. I'm curious as to where you see opportunity right now in terms of duration. Long end, short end of the curve, where are you?
Yeah, we're definitely on the long end. I think, the reality is everything that was pushing interest rates down prior to the pandemic didn't go away. Those are large demographic type issues. And because those haven't changed, the natural path of interest rate, they are to the downside. So now that we feel like we've really hit that peak in interest rates, we're extending duration quite aggressively to try to lock in this yield for as long as we can, because I see it as kind of an asymmetric trade. Worst case scenario for us is that, okay, interest rates stay about where they are for a while, and I'm happy to clip higher coupons. And then on the flip side, if we do see interest rates start to collapse, then obviously I'll get the price appreciation on the bonds. I think, the other scenario where we see interest rates go higher, I think is a very, very low probability right now.
Low probability. I'd like to know about the level of conviction in both the equity trade and in the bond market trade that you're putting on right now. Are you pretty much solidly convinced of the calls that you're making right now, or are you hedging maybe by squirreling away a little bit of cash at the moment?
So on the fixed income side, very, very convicted on that long duration trade. So in our fixed income portfolios, we are holding no cash. And like I said, we are extending duration. On the equity side, holding a little bit higher cash than normal. And like I said, and also hedging that with moving more defensively. So on the equity side, absolutely kind of hedging that out a little bit. But on the fixed income side, we're all in.
Adam, I'm curious as to whether or not you're seeing opportunities offshore. We get some data for China later in the week. I know that market has really had some tough times. It's been going on for a while. We're well aware of that. Is there anything in Asia right now that's attractive to you?
Unfortunately, no. And it's a trade that I want to put on, and it's one that I'm going to be watching and waiting for. But I think the reality is, as the U.S. economy begins to slow, so does China and the rest of Asia. It's just not immune from what's happening in the U.S. right now. And so until China can kind of shift away from being so dependent on exports, I think you're just going to see China go the same direction as the U.S. economy.
Adam, thank you so much. Great way to start the week with Adam Coons, Co-Chief Investment Officer at Winthrop Capital Management. He joining from Indianapolis, Indiana. Vishnu Varathan. He is head of economics and strategy at Mizuho Bank. It's always a pleasure to have a chance to benefit from your perspective. Can you let me know whether we're near the end of this yen carry trade unwind, or if there's a little bit more pain that we've got to deal with?
Doug, thanks for having me and such a kind introduction. My suspicion, and that's mainly because I'm a pessimist by nature, my suspicion is we're not quite decisively out of the woods yet. I mean, we've seen some glimmers of light, and the shakedown in and of itself does clear out some of the excesses and the extreme positioning. But I don't think we've quite seen the end of it for two reasons. One is markets continue to remain fairly jumpy, but at the same time, in so-called FOMO mood, where they're really not willing to miss out on taking risk at every opportunity. And that sets it up for latent downside volatility from time to time. The other reason is we continue to focus a lot on the BOJ being a source of yen-induced carry unwind, but really the bigger source of that is going to be the Fed. And if we again lurch back into a mode where the Fed would have to end up cutting a lot more and a lot sooner, that's going to kick off another phase of yen carry unwind inadvertently. And the BOJ probably could do very little to stop that, given they would probably not want to make huge policy U-turns one way or the other.
Do we have to be concerned at all about what's happening in the Japanese financial system? Are banks vulnerable?
I think generally the banks are in a fairly good position. One of the starting points for that, and of course you're going to say, I'm talking my position here. But,
who doesn't?
But okay, putting that aside, imagining that I'm somewhat independent here, I think the starting position for them was really good to get out of negative rates, because Japanese banks in particular, was struggling with the negative rates, and getting more steadfastly into a position where they're going to get a normal sloping yield curve that's somewhat steepening. That also ought to be good for the banks. So the banks are in a position where they can benefit from that, slowly diminishing the cross holdings, where the Nikkei is also in a healthier position, means that the banks are now positioned better in a structural perspective. But it would, of course, be negligent to say that heightened yen-induced volatility and the cyclical shakedown in Nikkei will flow through without any impact. So there are risks ahead. There's a need to watch that space very closely and to remain hedged. But overall, I think it's moving into a better position than it used to be in.
So we're also talking about a lot of leverage being unwound from the system as well, and that's got to be a healthy thing, I would imagine. Maybe you disagree.
No, I'm totally with you on this one, Doug. I mean, the process of unwinding is not so pretty, but often getting to a better place would require moments of unpretty, if you must. And it does get healthier that way. But the recognition right now is there is still quite a bit of leverage in the system. There's still quite a bit of liquidity in the system. And the liquidity it cuts both ways. It is a source of backstop, given that it does buoy markets and valuation, but equally, given just how intense and how precarious geopolitics is at the same time of the real conflicts and the U.S. elections and what it all means for Asia, it also exposes Asia to, I think, at least bouts of seizures and shakedowns, and that's something we cannot lose sight of. We
had comments from a former board member of the BOJ. We were talking about this earlier on the program, and from his view, another rate hike from the BOJ is not possible this year at all. Maybe the soonest we get movement is in March of 2025. Is that the way you see things?
Well, our view has always been that the BOJ would necessarily have to move very, very gradually and very cautiously. We were never very seduced by the wage increment story, because that was exaggerated by exports earning boosted by the yen. We were also very cautious of the fact that, we did say, that the yen is a BOJ problem with the Fed solution. If that's the case, then the Fed can easily move the needle and make the BOJ's tightening seem too much. From here on, given what the BOJ has indicated, we continue to be open to the prospect of another calibrated hike later in the year, if conditions so allow. And I think confidence doesn't cave. Particularly household confidence is not so great. But yes, we never thought that terminal rate was going to be significantly higher than where it is now. 50 basis points seems comfortable for a terminal rate that's approached, that has a longer approach, not just a 6-month or 3-month approach. But a 1% rate, I think, is a stretch, particularly given the uncertainty we are heading into end of the year in 2025.
It's amazing, because we just had one disappointing jobs report that kind of created the shearing. I mean, we were clearly at some level of a critical state here in markets globally, and it didn't take much to precipitate that. Do you worry that central bankers broadly are not monitoring the situation well enough?
I want to be fair to the central bankers, where I'm fully cognizant of them hanging on to the type 1 mistake that they made. being too slow to move on inflation that was there and a problem. And necessarily that also means they're getting into the type 2 mistake, clinging on to inflation being the boogeyman in the room when the balance of risks are shifting. Where they stand right now, I think the tricky part is what higher for longer ought to mean. And to the argument, so to use Governor Bowman's point, she said, look, inflation is still a problem, sticky, so on and so forth. We fully take that point, but the bigger picture here is, but does it really warrant a 5.5% rate at a time when job losses are starting to seep through, even if you're not in full retrenchment mode? The problem is this is a lagging beast. And like a huge vessel, it's very hard to turn directions of the job market, and usually it's a little too late when we see those signs. So that's where I think the Fed has signaled a lot more restraint than it probably ought to leave in the system over the next 6 to 12 months.
Unless they're just unwilling to say the quiet part out loud, which is that there is. Financial conditions are pretty relaxed right now. There are easy financial conditions to be concerned about. Is that a fair statement?
That's a fair statement, Doug. And in fact, I'm glad you brought that up. So the liquidity in the system, how risk is priced, where equities are, all that point to really easy financial conditions. There is always a sense in monitoring three aspects of policy separately. One is the policy itself, so that's the rates, and then monetary conditions, which is where exchange rates are and the rates are, and then financial conditions, the overall thing, the overall situation in the markets. The trouble with today's market is why it's getting hard to read is because increasingly there's a greater divergence between the very core policy conditions versus the overall financial conditions, which means a lot of the reaction function comes from sudden swings in markets, and the high correlation between asset classes means that financial conditions can really turn on a dime, and that's not a healthy position to be in. We'll
leave it there. Vishnu, it's always a pleasure. Thank you so much for making time to chat with us. Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, joining us from the Lion City of Singapore here on Daybreak Asia. Eric Lynch is with us, Managing Director at Scharf Investments, joining from Los Gatos, California. Eric, thank you for being with us. You're a stone's throw from Silicon Valley. Are people a little nervous about this AI trade right now?
I think so. Obviously, tech has had a wonderful run for really ever since the financial crisis ended. And, you had the AI kind of give it some extra legs post-pandemic. So, to have this kind of underperformance both in July and now actually 1/3 through August has been something that the market hasn't seen for a very long time.
So to what do you attribute that to? Was it the comment that we had from Sundar Pichai over at Alphabet? Is it the Microsoft report that kind of creates this apprehension?
Yeah, it's a good question. I think there's a couple things going on, Doug. I think one is you've got, a couple $100 billion of some odd estimated investment in terms of CapEx and the AI kind of data center. And to date, now, even though it's only been, less than a couple of years, you've got very little revenue to show for that. But that's not such an issue. The issue is that there's not a lot of clear visibility. So if you look at the Q2 earnings results, there was a very clear kind of pattern. The one stock, the one company that reported kind of lesser CapEx than could have been reported, but yet revenues kind of outperformed was Meta. The rest of the Max 7 kind of underperformed vis-a-vis the business outperforming expectations, as well as CapEx still being pretty significant both in this quarter and go forward. So I think it's showing you that investors are kind of nervous about the AI returns. But the other issue, Doug, which is actually a really huge positive, is that Q2 on the earnings season, we're 90% through. This is the first really solid year-over-year growth we've seen in several quarters. We're tracking for 11% for the S&P 500. That's off of 0 to negative in 23. And what's awesome about it is that it's broadening out. Recent quarters, Max 7 was responsible for over 100% of EPS growth. This quarter, there's a lot of things that are growing. Financial sectors on track to grow 18% year over year, healthcare 17%. Infotech is just barely ahead at 19%. So this is, I think, why you're seeing some of the broadening out of returns, because investors are realizing that, hey, maybe we don't have to wait for the AI trade to work. There's other stuff that's available.
Maybe it's a little ironic because now on the macro level, we're getting indications of economic slowing.
Yeah, that is interesting. And I'm glad you brought that up, Doug, because if you look at kind of what happened in July, everything outperformed tech, everything outperformed the Max 7, whether it was financials or it was small caps and value. It's more nuanced, right? In August, once we had these kind of blips with some macro data. And so what's really outperforming now are still a lot of different sectors vis-a-vis tech. Tech is down 6% at a sector level month to date, but staples are up 1.7, real estate's up 1.6. Utilities and healthcare are also up. So I think what that's showing is investors are still worried about the tech trade. They still think that the earnings are converging, but at the same time, they've got their eyes out on, wow, what if we don't have a soft landing? Perhaps we should be looking at some of these laggards of 23 and year-to-date 24 and put some bets there.
So speaking of putting your bets in the market right now, I'm imagining that expectations for a lot in the way of Fed accommodation here, that they begins cutting interest rates maybe as soon as September. Is that a part of your thesis, a reason to be bullish on equities?
Yes, I think clearly, any type of monetary kind of help is appreciated, right, for investors. We're still sitting on these, historically in the recent times, higher rates and certainly slowing down the housing market. Certainly some lower rates would help certain areas more than others. And so, yeah, that's part of it. I think the real part of it, though, and the optimism is that you're finally getting this broad-based earnings uptick. 11% earnings growth for Q2. When just a couple quarters ago, Doug, we're kind of sitting around 3 or 4, is pretty substantive. And what's nice is that you're also seeing profit margins up. Profit margins are tracking for 12.2 on the S&P for Q2 earnings season, and that's notably higher than where we were in Q1. And also, much higher than where we were a year ago. And kind of perhaps correlated with that is you had a strong productivity improvement, both in Q2 as well in 5 of the last 7 quarters. We've got U.S. productivity kind of growing 2.7% year over year in Q2. And that kind of 2% plus, Doug, is something we haven't seen since kind of the post-tech bubble of the knots.
So Vice President Kamala Harris is going to be in San Francisco for a fundraiser. She's leading in a number of the polls. Talk to me very quickly, Eric, about regulatory risk of a Harris-Walz victory. I mean, are you concerned about the way in which big tech could be impacted by such a thing?
That's a great question. Clearly there's probably more risk, but at the same time, based on the rhetoric, but at the same time, both parties are kind of intriguingly and probably not great for business, big business and public equities, are kind of converging on certain points, whether it's, kind of anti-capitalist kind of tariff rhetoric, or it's kind of anti-tech rhetoric. They're saying kind of the same things. We're differentiate or also, kind of underwriting exceptionally high kind of federal deficits, which long-term should be inflationary and crowd out private investment. So both parties are kind of subscribing to this new normal of the policy framework, which isn't exactly great. Now, the benefit of the Trump campaign is they're kind of advocating an extension of the tax cut.
Eric, pleasure as always. We'll leave it there. Eric Lynch from Scharf Investments joining us here on Daybreak Asia. Louis Navellier joins us. Louis is founder, also chairman at Navellier Associates, joining us from Florida. Louis, it's always a pleasure. Before we get into technology, I'm sure you have a lot to say on that front. Let's talk about the volatility last week, and the underpinnings of that seem to be an unwind of the yen carry trade. I'm just going to shoot right here and ask whether you think most of this unwind is behind us now.
Yeah, it looks like about 75% is. Obviously, we need Japan to open up firm like they did since Tuesday. And because, if Japan opens down weak, we're going to gap down as well. But bond yields firmed up quite a bit last week with the Treasury auctions, and some of them didn't go that well. So it's just a sign that you can't get yields too low too fast because the market won't buy the bonds. So I think we found equilibrium here. A lot of the carry trade risk has dissipated, but we're still in August. We still have air pockets. And, most of my Wall Street friends aren't at their offices and will not be until after Labor Day.
Air pockets. Talk to me about what you see right now in markets. Where are the risks?
Well, I think the best way to explain air pockets is August of 2015. We had one day there where some circuit breakers were hit. And what happened is some stocks couldn't open, but the ETFs opened. And but they couldn't price the ETFs because the stocks were open. So a lot of ETFs went down immediately, almost 35% at the opening, stayed there for over 90 minutes. At the end of the day, prices were largely unchanged. So that's the risk of August. I recommend a lot of small cap stocks. Obviously, we're static with a small cap rally. But, when I look at my best small cap stock, something like a Powell Industries, it's a money stock. It sits, it hops, it sits, it hops. And people have to realize when they go in the small cap arena, that's what they're going to get. I think the liquidity will be a lot better if we get an early January effect in November, just before Thanksgiving. We want to get all our distractions out of the way. Clearly, we want to get the election out of the way. We want to get the Fed cutting rates. And then we want to, have optimism for the future.
Do you think there's still too much leverage in the system? I mean, putting the yen carry trade aside, the Fed and its balance sheet, global central banks, their balance sheets are still very, very large by historical standards. Is there still too much liquidity?
No, but there is leverage, and that's a very good point you brought up. Your average financial advisor doesn't sell stocks; they sell leveraged debt, and it yields about 11%. And you've got these little exit windows, and because it's a very popular seller, and because the exit is restricted, I worry that if something goes bad in that arena, this is a $2 trillion a year industry, up from about 438 billion a decade ago. But I worry if something bad happens there, it'll be a mini black swan event, and the whole market will freeze up. And then that will definitely cause the Fed to cut, because we've become like China. We have two tiers of lending in America: the banks, if you have a perfect credit score, and then private credit if you're less than optimal.
Where are you seeing AI right now? I mean, there was a big unwind, obviously, as a part of that yen carry trade unwind. We saw mega cap tech very hard hit. I mean, how are you still positive here?
Yeah, I'm still in the camp that 80% of your AI investments should be NVIDIA and Supermicro. Obviously, Supermicro missed, but they guided higher, and they still had 143% sales growth. There seems to be some sort of delay with the Blackwell chip from NVIDIA. Whether it was quality control or what is another matter. But NVIDIA's incredible sales that come from their previous chips, and Blackwell's only going to make it grow faster. So NVIDIA's lock and load now. Supermicro's only 11 times forecasted earnings, so it's fairly priced.
We're going to get earnings from NVIDIA at the end of the month, I think, on the 28th after the bell, which will make the next day in the cash market very, very interesting. Are you expecting a big beat here? What's your sense? And if there's disappointment, what happens?
Well, NVIDIA will be the grand finale, regardless of what happens. They have an incredible history of beating. I think Jensen is one of the few founders that can actually run his company. Most of these tech founders have to be replaced by professional management. And I have nothing but the highest respect and hope for him. But yeah, if you want regenerative AI chips, NVIDIA is the big game.
If you mentioned Supermicro, NVIDIA, I mean, is that the only way to play it right now?
Yeah, that's the hardware side. Obviously, you can buy Microsoft and get on regenerative AI with ChatGPT. Obviously, there are a lot of low-tech AI chips coming out. AMD's trying to catch up. I have a friend in Boise, Idaho, that's building low-tech AI chips for Samsung. It's basically like a super Alexa. The chip tries to figure out who you are. It's no different than our pets conditioning us at home, and it's just they'll have consumer electronics things that will try to learn and understand us better.
What about playing NVIDIA through TSMC? Is that advisable in your view?
You could, but I'd like to see TSMC's plant in Arizona start up. That's a big question mark. I mean, I suspect they're going to have to move a whole bunch of Taiwanese to Arizona to get it going. It's funny. I have a lot of friends at the Tesla plant in Reno, and they work on the Panasonic side, the battery side. And there's plenty of Japanese from Panasonic in Reno, too. In fact, the kids are pretty good at baseball. So I suspect as soon as Taiwan wants to get some engineers to move to Arizona, I think it'll run a lot better.
Interesting. Louis, it's always a pleasure. Thanks for making time to chat with us. Louis Navellier, founder, chairman, Navellier Associates, joining from Florida. This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.